Hi traders, welcome to the update for the 21st of January. So we're starting to get in a bit of a choppy period there for sort of early on the 21st in the pre-US session. So we got into a long and it got stopped straight out, so that wasn't very good. And the previous short was out at break even from memory, so got in there. Oh no, it was a couple of points in the deficit. So we went into a long and stopped out. So then we got into this nice short at the moment. So everyone should be short from that point there, which is 920 odd on the 21st, and an entry of 1128.75. So the green line is where we entered, and then we're just bringing our stop down, which is off the yellow dots, and we'll just continue to drag our stop down. And this is an active trade, it's live, and your stop should be in the platform here at 1118.70 or 1118.75. So we'll just double check that at the moment. It's an open trade, so 1118. So that's where we are at the moment. That is an open trade. So we'll keep tracking this. So this is the reason why we have the hedge. So to combat any large sell-off or rally. So this is a perfect example of how the system works. We set our spread. Now that isn't realised until the end of the expiry date. So we're in a winner straight away, and then we hit a bit of a choppy period. This is what the futures does. Just chops in and out until there's that big breakout move, and that way we're making money on the futures as well. So we're really double dipping. We're making money on the options when we set our spread, and then we're going to catch these bigger moves that happen throughout the expiry period, and we're going to make money on the futures as well. So there's every chance that this could keep selling off, and we just keep clocking up the profit here on the futures side of it. And the main reason we have the hedge is not just to make profit, but is to protect our positions on the spread. So our position down there, it is a sort of 10.05 is our put position. So if this market was to keep selling off and go straight through our put for whatever reason, well, that means, again, like I've said this a few times, we've made money from when we entered the market. So way up here at 1128.75 is where we got in. So if this happened to rally, I mean sell off right down to 10.05, we've made 100 points. So that's the way it works. So it completely hedges your options. So if you've got any questions, please email myself, Luke Ferguson, email address is admin@keyequityhedge.com, and I'll give you some more answers to any questions you have. But for now, just keep your position live, and it's still short, and you should have your stop at 1118.75. So it's just a matter of just adjusting your stop as the market keeps selling off, or look for that next trade to go long if it stops out. But if you're having it auto traded by the broker, well, they're doing all the work for you. All you're doing is checking your daily positions, and that's it. It's pretty easy for the guys or the traders that are having it auto traded. You just set your spreads once every 45 days, depending on the size of your account. You might stagger 4 or 5 spreads if you've got a $500,000 account. Remember that it's one spread or one strategy per $100,000, so we stagger that to spread the risk. And you're just checking your daily updates to make sure that they're going on as per the system dictates. So you're just checking your statements really from the broker. So it's pretty easy to trade. It's an easy system, and I'll give you another update tomorrow with where we're at. Happy trading.